What if I told you that right now, today, there are three types of accounts that are legally, completely, 100% invisible to the IRS, not hidden in an offshore bank, not buried in some complicated tax shelter that only billionaires can access, not the kind of thing that gets you in trouble. I mean accounts that Congress itself built into the tax code, accounts sitting right there, available to every American retiree, with the specific purpose of keeping your money out of the reach of federal taxation. And here is what will genuinely surprise you. The vast majority of American retirees, people who have worked for 40 years, paid taxes their entire lives, done everything the right way, have never used a single one of them. Not because they are not eligible, not because they cannot afford to, but because nobody ever sat them down and explained that these accounts exist. And that is exactly what we are going to fix today. My name is Marcus Grave. For years, I have been helping retirees find the money that the system never told them about. Stay with me for the next 15 minutes, because by the time this video ends, you are going to know about 3 accounts that can legally shield your retirement savings from IRS taxation permanently. Now you are probably wondering, what exactly are these 3 accounts? How do they work? And most importantly, can I still use them even if I am already retired? The answer to that last question is yes, and I'm going to walk you through each one step by step, starting with the most powerful. Account number 1 is called the Roth IRA. Now, I want you to stay with me even if you have heard that name before, because what I am about to tell you is the part that most people never learn, the part that makes this account genuinely invisible to the IRS, and the strategy that allows retirees, even people already in retirement, to get money into one. What it is and how it works. A Roth IRA is a retirement account where you put in money that has already been taxed. You pay the tax up front, and then everything from that point forward is completely free. Money inside a Roth IRA grows tax-free, not tax-deferred, not tax-reduced, tax-free, forever. When you take money out in retirement, no matter how much it has grown, no matter how long it has been in there, you pay 0 federal income tax on that withdrawal. 0. Every single time. Why it is invisible to the IRS. Here is the legal reason this account is invisible to the IRS, and it is simpler than you think. Roth IRA withdrawals do not count as income. They do not show up on your tax return as taxable income. They do not affect how much of your Social Security is taxed. They do not trigger Medicare premium surcharges. They do not push you into a higher tax bracket. Congress built this into the Internal Revenue Code under Section 408A. The law specifically states that qualified distributions from a Roth IRA are excluded from gross income. That is not a loophole. That is the law. The money simply does not exist as far as the IRS is concerned. How retirees can set this up. Now here is the question I get most often. I am already retired. Is it too late for me? The answer is no, and here is why. There is a strategy called a Roth conversion. If you have money in a traditional IRA, you can move a portion of it into a Roth IRA. You pay income tax on the amount you convert in the year you do it. And then, from that point forward, that money and everything it earns is completely tax-free forever. The best time to do this is in the early years of retirement, before Social Security reaches full amount and before required minimum distributions begin. That is when your taxable income is at its lowest, meaning you pay the conversion tax at the lowest possible rate. To open a Roth IRA, contact any major financial institution, Fidelity, Vanguard, Schwab. All of them offer Roth IRAs. You can open one online in less than 30 minutes. Please note, everything I am sharing today is for informational and educational purposes only. This is not tax advice specific to your situation. Before making any decisions about Roth conversions or opening new accounts, please speak with a qualified tax professional or financial advisor who can review your individual circumstances. Account number 2 is called the Health Savings Account, or HSA. And I want to be honest with you about why most retirees have never used one. It is because most people think of it as a medical account, a place to set aside money for doctor bills. Useful, but not powerful. That is the wrong way to think about it. Because a health savings account is the only account in the entire United States tax code that gives you a triple tax benefit. What it is and how it works. Triple tax benefit means exactly this. First, money goes in tax-free. Every dollar you put into an HSA is deducted from your taxable income in the year you put it in, dollar for dollar off the top. Second, money grows tax-free. Once inside the HSA, you can invest your money in mutual funds, index funds, stocks, and everything it earns grows completely free of federal taxation. Third, money comes out tax-free. When you use HSA money to pay for qualified expenses, doctor visits, prescriptions, dental care, vision care, Medicare premiums, long-term care, you pay zero tax on that withdrawal. Zero on the way in, zero while it grows, zero on the way out. There is no other account in America with that combination. Why it is invisible to the IRS. The HSA is protected under Section 223 of the Internal Revenue Code. Congress created it specifically to allow Americans to save for healthcare costs without federal taxation. But here is the part that makes it truly invisible, and most people never hear this. The IRS does not put a time limit on HSA reimbursements. That means you can pay a medical expense out of pocket today, keep the receipt, and reimburse yourself from your HSA 5 years from now, 10 years from now, even 20 years from now. As long as the expense happened after you opened the HSA and you have documentation, the reimbursement is tax-free, so a smart retiree pays medical bills out of pocket while working, keeps every receipt, lets the HSA grow tax-free for decades, and then in retirement pulls out tax-free income by reimbursing those old expenses. It is completely legal, completely documented, and completely invisible to the IRS as taxable income. How retirees can set this up. To open an HSA, you must be enrolled in a high-deductible health plan, also called an HDHP. You cannot contribute to an HSA once you enroll in Medicare, but here is what most people miss. You can keep using the money already in your HSA after you enroll in Medicare. You can invest it, let it grow, and withdraw it tax-free for medical expenses for the rest of your life. For 2026, the contribution limits are $4,150 for individuals, $8,300 for families, plus an extra $1,000 if you are 55 or older. To open an HSA, speak with your employer or contact HSA providers like Fidelity or Lively. Many can be opened online in minutes. As always, this information is educational only. Every person's health insurance situation is different. Before opening an HSA or changing your health plan, please consult with a licensed insurance advisor or financial professional who understands your specific needs. Account number 3 is called the Roth 401k, and this one surprises people every single time, because it has been sitting inside employer retirement plans for years, and almost nobody uses it. What it is and how it works. Most people know about the traditional 401k. You put money in before taxes. It grows. You pay taxes when you take it out in retirement. The Roth 401k works in the opposite direction. You put money in after taxes, meaning you pay the tax on it now. But everything from that point forward, all growth, all earnings, all withdrawals in retirement is completely tax-free. For 2026, you can contribute up to $23,000 into a Roth 401k if you are under 50. If you are 50 or older, that goes up to $30,500 with the catch-up contribution. Why it is invisible to the IRS. Just like the Roth IRA, qualified withdrawals from a Roth 401k are excluded from gross income under the tax code. They do not affect your Social Security taxation. They do not trigger Medicare surcharges. They simply do not exist as income on your federal tax return. But here is the critical difference between a Roth 401k and a regular Roth IRA. And this is the part that matters most for higher income retirees. A Roth IRA has income limits. If you earn above a certain level, you cannot contribute directly to a Roth IRA. A Roth 401k has no income limit. None. Zero. A retiree earning $300,000 a year can still put money into a Roth 401k and have it grow completely tax-free, just the same as someone earning $50,000. How retirees can set this up. If you are still working, even part-time, check whether your employer offers a Roth 401k option. Many employers now offer both traditional and Roth options inside the same 401k plan. Simply ask your HR department or plan administrator to switch your contributions to the Roth designation. If you are already fully retired and no longer working, your opportunity here is on the withdrawal side. Combine your existing Roth IRA and Roth 401k balances with a careful withdrawal strategy to minimize your total taxable income each year in retirement. As with everything in this video, this is educational content only. Roth 401k rules can vary by employer plan. Please speak with your plan administrator, a certified financial planner, or a qualified tax professional before making any changes to your retirement contributions. So, let me leave you with this. The IRS is not your enemy, but the IRS is not your financial advisor either. The IRS collects what it is owed based on the income you report. These three accounts, the Roth IRA, the health savings account, and the Roth 401k, are your legal right. They were built into the tax code by Congress specifically to allow Americans to shelter money from federal taxation. They are not a loophole. They are not a trick. They are the system, working exactly as intended, for the people who know how to use them. You now know how to use them. Before you go, I want to ask you to do one simple thing. Hit that subscribe button below this video and tap the bell icon right next to it, because next week I am coming back with a topic that directly affects every senior who receives pension income, and most people have no idea how much of that pension money they are giving away unnecessarily every year. Next topic teaser. Next video, pension taxation. If you have a pension, federal, state, military, or private, you need to watch that video, because there is a way to legally reduce the tax on your pension income that most retirees have never been shown. Subscribe now and you will not miss it. And before you close this video, please share it with one retiree in your life. A parent, a sibling, a neighbor, a friend. These three accounts could change their retirement. One share from you, right now, could be worth more than any gift you have ever given them. I will see you in the next one.